Is too much seller credit to a buyer a good thing or a bad thing, or is it a confusing thing? Well, we just have a conversation. I'm Bill Gross, at Bill Gross Probate and Social Media. We host this every week with new episodes on Friday, the Home Buyer Seminar, along with my colleague and good friend,
Patricia Castillo. Hi, everybody.
And our lender,
Shen Lender. How's it going, guys?
And the thing we're talking about is, what happens normally is a credit from the seller or any third party to a buyer can exceed a certain percentage of the sales price and gets applied towards the non-recurring closing costs. What happens if the credit being given to the buyer is too much and exceeds those non-recurring closing costs? What happens? Is that a bad thing or good thing, Patricia? Just yourself.
Yeah. So I think, it really depends on the amount of the credit that's being given. And from my experience, what I've seen is it's when sellers and lenders are looking at the closing statement, it's, they're looking at all the calculations, they're looking at the debits and the credits. And let's say, for example, an FHA loan, depending on the loan type, the buyer is required to inject a certain amount of cash into the deal, whether it's 3.5%, 20%. And so sometimes if the underwriters see that the buyer is, if the credit is so big that if it's large and it looks like it might be giving the buyer too much credit where they're not putting in the 3.5% down, I think that's when it gets a little confusing. And then the listing agents also say, well, we're trying to get our seller the highest net possible. So they don't want to end up giving too much of a credit, right? So I think that's where it gets a little sticky, is when the buyer is trying to exhaust the full credit amount that they can possibly get. But then the seller may end up saying, well, you're actually getting too much here. They might want to try to renegotiate and take some of that credit back or reduce it. And I think in the underwriting stage, and Shannon, you can touch on that, that's when I think it gets kind of sticky, is when the lenders want to see the exact numbers that make sense. They don't really want to look at a creative way to give the buyer more of a credit or to apply it somewhere else, right? Because it has to be used for either closing costs, recurring or non-recurring. And so when it has to do with maybe changing the sales price or changing the loan amount, then I think that's when it gets could get confusing.
Yeah, especially when you're at the tail end of the transaction, you're pretty much at closing. When you're balancing, that's the very fine line you have to play with, because at balancing, that's when everything, the nitty-gritty comes. And that's when I think I had something similar where we're off by like $500, but that $500 made all the difference, right? Because again, like Patricia says, they don't want you to go over the closing costs, right? If you're putting down 3.5%, 5%, you need to put that exact amount down, no less than that. But Bill, actually, you had a good point about what if you have a great agent like Patricia or Bill that has given you more credit than even what your closing costs are. What then? That's a good problem to have.
Yeah.
It's still gonna be a problem, though.
Too much money.
Well, it's never. So here's the thing: it's never too much
or in excess.
So here's the thing: if your contract says seller to credit buyer, $10,000 towards non-recurring closing costs, and they only have $8,000 of non-recurring closing costs, then the seller only has to pay $8,000, not $10,000. So you want to write it that way. If that was the case, what you would do is you would increase your closing costs, your non-recurring closing costs, for example, if there's things that that you didn't run through escrow to pay for, like the inspection. You want to make sure it's on your closing statement or the appraisal, whatever. But there's a point where you can't do any more. So now you have $10,000 the seller is prepared to cut your check for, unless he can only use $8,000 of it. What do you do with it? If it's written non-recurring closing costs, not much you can do. If it says towards closing costs, the lender will say, well, you can only apply it towards non-recurring closing costs. Then after that, the extra counts as though you're lowering the sales price. So what does that mean? So if your sales price is $500,000 and you have $10,000 of too much closing costs, so we'll call it an excess, the lender will say, well, we're not going to base your loan amount based on a $500,000 purchase price. We're going to base your loan amount on a $490 purchase price, so $500 minus the $10,000. And if you're getting a 9% loan instead of a $450,000 loan, they're going to lower it by 90% of the $10,000 or $9,000. So your loan amount's $441. So it has the effect of lowering the sales price, but you as the buyer still have to pay your down payment percentage on the new adjusted sales price theoretically. It doesn't change the sales price. It changes the calculation of the sales price value for the lender. So you still have to pay 10% of the amount you had to pay otherwise, and you still have to pay your non-recurring closing costs. I'm sorry, you still have to pay your recurring closing costs, prepaid interest, taxes, and insurance. That doesn't change. But what does change is, in essence, you got about a $9,000 deduction on the cost of the house in terms of the seller paying that money extra in. But the lender's saying, well, since you lowered the sales price by $10,000, we're going to treat it as though it's a lower sales price. We're going to lower the value of the total of our loan. So it's not a bad thing to have too much closing cost. It's not as good as it all being out of your down payment and closing cost pocket, but it's still a good thing. If, however, it's written as the money goes towards non-recurring closing costs, if you don't use all that, you lose it. And that's where there's a distinction how the contract's written.
Right.
Well, that's good. I even learned something new.
Have you seen something like that in the past? I actually have not seen or worked with a lender that was willing to adjust at that point. It's more of how are we going to apply what we have right now and continue with the way the loan has already been underwritten. The buyer has already been approved for a certain amount. Obviously, lower is always going to be easier rather than going higher on the loan amount. But it just seems like that would be something a little bit more creative on the lending side. They'd have to also be in agreement to structure it that way. I have seen principal reduction.
Yeah, I mean, okay, that I haven't seen. I have added more to the closing costs in terms of, hey, now let's get your termite done, right?
Yes.
Actually get it, the whole invoice paid.
Yes.
That's I was able to do that. You know, you can actually get roof done too as well. You can actually get some contract work, but it needs to be done, hypothetically speaking, before closing.
Yes.
Mm-hmm.
So that's one thing technically. So I was able to actually do that, or even pay more into your prepaids, get more coverage on your insurance. So there is a couple creative ways. Again, if you're a few thousand off, hey, you know, is the termite done? Is there any work that maybe you can just pay already up front, get it done right away, and just, you know, that way you're not losing that credit. So yeah, that's actually some things that I've worked with, you know, because we're right at the wire. You know, we're probably a few days from funding and we have to figure this out. So that's actually one of the ways I've done. Or like you said, pay for the appraisal.
Yeah, if there's enough there, maybe it can be used towards a rate reduction, even if it's a temporary rate reduction for the first year.
That can't be done because that's a recurring closing cost. The rate reduction is prepaid interest. So you can use to cover the origination fee, processing fee, funders fees, all the fees that are charged at closing. You can't use it to pay for a buy down. Well, I should say, if you use it for the buy down, that's a recurring closing cost. So there's limits to how that can be done.
But I usually see on contract they'll put credit towards non-recurring and recurring closing costs, right? That's usually how I see it now. So if they do that, Bill, is that now can they do it if they put that verbiage in?
So you can use the money to pay for the recurring closing costs, i.e. the buy down fund. But again, it's subject to the limits of the type of loan. Usually it's 3% with an FHA, 6%, I think 9% loan, and 9% with 5% done more. So you can still use the money, but what happens is the lender will, based on those limits, lower the sales price. I'll tell you another place where this comes into play is you'll see a rookie error for real estate agents is the house maybe is furnished, or maybe it has like a nice sub-zero refrigerator that's worth, I don't know, $10,000 or something, or a pool table they can't move out of the house. So they'll say includes what clearly is not real property, i.e. attached to the house. Sub-zero, you can make a case. I think that's real property. It's debate, debate. Like a pool table or furniture clearly is not real property. And by license, that's a bulk sale. It's a whole different contract. Lenders won't finance it. So what happens is the lender will typically say they want the appraiser to identify how much of that value is that item. Let's say the pool table. And then they'll deduct that from their loan calculation. They'll say, okay, the house is $500,000. We're going to say the pool table is worth $10,000. So in essence, we're going to make our LTV based on the 490 figure rather than 500 figure. So it's the same thing. That can a seller pay for the pool table? Give it to you? Yes, but that will affect the lender because the lender can't finance the pool table.
Yeah, I had a closing like that in Claremont where the seller, she was a flipper, and so she did an amazing job on the upgrades, remodeled the entire property. It was gorgeous. And then she staged it herself. So she also does her own staging, and it just looked like just the way it was showcased looked like just something that was brand new, right? Like brand new construction, freshly done, brand new furniture. It looked really pretty. And so the buyer said, well, we want to buy the furniture. And so we ended up just handling that outside of escrow. So it's not included in the contract. It doesn't interfere with lending, the type of contract. It's a little more streamlined. So we just had an agreement outside of escrow that the furniture would stay and the buyer was going to pay an extra $3,000 for the furniture. So that was handled outside.
The challenge with that is, just full disclosure, that if they're paying $3,000, that's a separate transaction. Mm-hmm. And what you do is you make a contingent on the close of the escrow. So the buyer's protected. If the escrow falls apart, they didn't buy the furniture they don't really want or need. And so that becomes subject to, I'll buy all your furniture for $3,000. Where it's a problem is when they throw it in, because in essence, that's kind of frauding the lender because they're paying more because of this concession that you're not disclosing perhaps to the lender. And so there, in that case, an attorney a long time ago advised me, at least make a contract for $1. Legally, $1 is considered consideration. And you can argue about whether there is or is not consideration. You can if there's $1 charged. You can if there's zero. So it's one of those things where, at least to protect the client, you should always have some sort of contract. And should you disclose that to the lender? That's another question. It's out of my pay grade, but as a realtor, I say that's really not for me to get involved with. That's between you and the seller.
Mm-hmm. Yeah, it worked out, and both sides were happy.
There you go. That's our job, right?
That's the main thing.
Keep the main thing the main thing.
What was the challenge that you had, Shannon, with the going back to the closing cost credit and the extra $500?
Well, technically it was $1,200. And I was able to, again, I think what I was able to do is just pay for the termite, and they actually got a better insurance. So they just increased their insurance a little bit, got a little bit more better insurance, and then that covered the closing costs. So yeah, because they didn't want to lose that credit, and we were supposed to close.
Mm-hmm.
Yeah, instead of going with the lesser one, I said just go with more coverage. It doesn't hurt. And then that in turn increases your prepaids, which is so you have to prepay a few months of insurance, for your escrow account. Right. So they had to increase that, and it pretty much helped them on that end. So we're closing today. So
very good.
Yeah.
Yeah. And
but again, these are another things too. Go ahead.
No, I was just going to say, when a buyer is getting pre-qualified, I've had agents on some of my listings that will call me and say, they tell me right up front, we have a loan approval. My clients are pre-qualified for X amount, but they need money for closing costs. So is it worth submitting the offer, right? In other words, is the seller even going to consider giving the buyer a concession for the closing costs? And so that's something that we would have to discuss, present the offer, and discuss with the seller. But I've had agents that have called me and said, we're looking for sellers that are, going to be a little bit more flexible and help out the buyer with closing costs, because they're qualifying for the purchase, but they do need help with closing costs. And so I think that's something that's also looked at in the beginning. What is a financing that the buyer is going to qualify for? What are the assets they have currently that they can use towards some of the prepays they're going to have, like home inspection, appraisal, termite inspection, things like that. And after they close escrow, I mean, a buyer, it's usually not a good idea to zero out your account, right? You've bought a home and now you have zero in the bank. So
Exactly.
you have some assets left over in your checking or savings account. So that's a strategy also is I've seen lately is that agents will call me and ask, is your seller going to help us with any closing costs, before we even send you the offer, so that they're also preparing their client, their buyer, and also not wasting time and waiting to see if there's going to be a response. Some sellers are right off the
Yeah.
bat, they say they're not going to help with closing costs, but then they change their mind, right? And they end up, if the home is sitting on the market a little bit longer, they end up being a little bit more flexible, and so there could potentially be a deal there for buyer and seller.
Makes sense. I mean, and that's what a great agent's for, to make it happen for all parties involved. A win-win scenario. Well, actually, I can say on live, I've learned something new today.
That's why we do this.
That's right.
That's why
This
we
is
do this. I love
educational home buyer workshop.
Well, I
Exactly.
think that said,
Education for all.
we have a holiday weekend coming up. You guys working this weekend? If you're not, let us know. If you are holding open houses, or how people get a hold of you.
Yes. So my cell is the best way, 323-365-9909.
Fantastic. Any open houses this weekend?
My
Or are you
cell
off the weekend?
661.
Oh.
No, go
Go
ahead.
ahead.
Any open house this weekend? Or are you off for the weekend?
No, not this weekend.
Okay. And Shannon.
She's finally taking a break.
Yeah.
I've never heard that before.
Yeah.
No open
It has
houses this weekend.
while.
You better.
And Shannon, how
But yeah,
many
you
people
can reach
get
out to me 661. Yeah, 317-8484. My Instagram fund with Shannon. I will be taking calls. If you have anyone that wants to get me pre-qualified, or if you're looking at buying yourself, please, reach out to me, give me a call, and we can get you qualified this weekend.
Fantastic. Okay, well, on behalf of Shannon and Patricia, I'm Bill Gross at Bill Gross Probate and Social Media, and we do this every week. The new episode drops on Friday. Thank you for support. Look at your comments, feedback. If we can help any way, let us know. And as always, make today your best day ever. Thanks so much.